so nice. All right, what was I going to say? Weekly positive thought. Let's begin. Good morning, everybody. It is the, if I'm not mistaken, close to the last week of the month of March. We're going to get done the last full week with the month of March. Let me put it to you that way. So we've got the conclusion and the follow-through with the quadruple witching, number one. We've got end-of-quarter window dressing that's coming up. They talk about the Ides of March and, of course, having some disastrous market turns in history, and this is from a seasonal perspective a weak time for the markets. While I believe to pay attention to all of that, many of you know on Friday I dumped my IWM calls and we initiated some spider calls the other day, and so I'm hanging, and I'm kind of like not trying to out sophisticate the market bit. What I'm trying to do was that I was in the IWM calls, and for the amount of time I was in them and the performance that moved, right? And just everything between theta and a pause in the Russell that may occur and maybe spillover strength that might happen in the spiders, I thought it would be nice to take something off the table. And so while I'm still exposed to the long side of the market, and I also have some positions in on Twitter, I have some positions, as you guys are with me by mistake. I bought Mondelez because I had the wrong darn thing up on my platform, and I wanted to get in, which we did, to Seagate STX on just directional call plays. So what am I looking for going forward? And real simple, I think the weekly positive thought, the reason I like that is learn to be happy with what you have while you pursue all that you want. That's by a guy by the name of Jim Rohn. What this really means for me is simply this. A lot of people are new to the markets, and they're kind of getting ahead. They're trading the market. And I'm going to tell you, in this environment, after coming off listening to people in San Francisco and listening to a lot of stories, and a wonderful letter that was sent by one of our own students last week, who's not in the room right now, I don't see. It was very moving, and it was also enlightening in the fact that a lot of people are struggling and losing money in this market still. Lots of money. Like getting ready to quit the business, losing money in this market. There's only one reason I can say that they're doing that, is that they're fighting the tape, they're fighting the trend, they're trying to pick a top in a market that continues to go up. How many times have I personally said, hey man, I'm buying the market now. It's okay to trade the market, because we came into, when we were at New York City, we did the commitment of trader analysis. We looked at some seasonals, we looked at volume, we looked at AD lines, and we were in spider puts. I made no bones about that. From yelling at the highest mountain, guys, I'm in puts. Do what you want, but I'm in puts. And not that I'm going on a rant, I think that I gave explicit reasons, and the indicators we use have been very effective. We did an open house, which I'm not sure, a lot of people were looking for a lot of action, maybe from a day trade perspective, and what I was doing was I was unwinding my position trade. I scaled out of the spider call. What did I do? I went from going short the market to covering my short positions, and then that phrase, getting a feel for the old girl, and then we went right into the IWM call. So we went from bearish to neutral to bullish, right? And I mean, that's defining trend trading, right? And that's what this market has been doing and giving us, and then on those dips, we accumulate positions. So I think that's part of, in the market thoughts and observations, what we've been doing. We also had a nice little trade in the FXE, which you guys know well before the fact that was a nice little trade. Did I get out a little early? Yeah, maybe, but you know, it's okay because it hit an objective, and I was looking for a 1 to 2% move, and we got it from a lower level. But so there have been a lot of decent opportunities here. So this week, when I wrote this was last week, but this week, Wednesday, I'll be taking off to Paris. I will not be in the room Wednesday, or maybe no, maybe Wednesday I will be. I think we leave Wednesday afternoon, excuse me. So I won't be here Thursday or Friday, and possibly we'll see what happens Monday. I have to double check my schedule on that just to give you guys a heads up. And then we will decide on how to continue with the weekly thoughts and observations. The next aspect is, I guess, what I wanted to take a gander at is what I always take a gander at and start these sessions on Monday's planning and scanning, is to just say, well, what's the condition of the market, and what should we be focused in on? I want to look at a couple things this morning with you guys. I want to look at the COT data, and it does suggest that specs lost some money in that downside move. You know, I also want to take a look at from a daily perspective all the stock indices, and I want to look at the weekly perspective of all the stock indices. All right, and I want to look at not just the price action. I want to look at the condition of the market. The one sector that we can clearly see in a breakout mode. So perhaps from a trading perspective, one would say, John, if you're about to tell me that the Russell is broken out of this trading range, tested the old resistance, which turned into support, rallied straight up into quarterly pivot resistance, had a new high breakout with the advanced decline, had a new breakout from the recent highs with volume, why in the world did you get out of your long call positions? And it's real simple. We're at resistance, the market over accelerated, and we had a little bit of time that went by, and if we do see a pause, or if the market does what markets tend to do when they trend, is they pull back a little bit and then they go up again. And so with that said, I will more than likely look to re-enter a different or roll into a new Russell call position on a dip. But in the meantime, I am exposed to the long side of the market. So from a volume perspective and from seasonality, we still have strength going into the small cap, believe it or not. And by looking at this volume, you can see that a lot of, and this is not a daily chart, folks, that's a weekly chart, that there's still an enormous amount of volume. And if we're looking for understanding where's the volume coming into the market, the volume from a perspective of using the OBV indicator, you can clearly see that we are getting a volume move relative to the other stock indices. There's more money pouring into the small cap. So what's the problem with the S&Ps? Well, the S&Ps actually do have strength. The Ides of March, if we may take a look at this real quick. So here's what we see typically, as they say, we get that little sell-off, the Ides of March. And then going into April, the first week of April, we have a little move up. You tend to get a move down as we pay for Uncle Sam's taxes he wants on or about the 15th. And then we see a move that generally tends to move higher. The overall trend is up in this time frame. And what I think is going to happen, what's really impressive, is the fact that if we look at the financials, if we look at the energy complex, we would say that's probably a drag on the market. So we did not repeat in at least the spiders. We closed at 210.30. We just closed slightly above that 210.30 without making a new breakout of an old high. But when we look at the advanced decline, we perked our little bitty head right above that old level. So the one element that's kind of missing is volume. So what's my take on this? And why did I dump Russell to get with spiders? Because I think if we see some type of recovery in the energy complex, and as more and more fund managers decide that, oops, I've got a problem, I'm not exposed to the market. And you got to know there's a lot of fund managers who are on the sidelines. Everyone was expecting the Fed to want to raise rates sooner rather than later. That's what was priced in the market. And now the Fed's taken raising rates off in June away. We've got the next FOMC meeting on April 27th. That's the next announcement. That's why I put it in there. So that's going to give us what? The April jobs number, and then we go from Easter, and then we go into a whole month of economic reports, and then we get into maybe finding out what the demand really is for energy, and if we start peeling away some of that inventory. Now, if we start to see an increase in energy stocks, then possibly, if that's what's been keeping the S&Ps weighed down and accelerating to the upside, if the financials start to recover as well, and consumer spending starts to increase, and that would be retail sales that we would want to look at, right? Then this market's going to get ready for a blow off to the upside. And it's not going to be a meltdown as much as a potential melt up. And that's kind of why I think we might see from an A, B, C, a D experience in the market. If you look at this range and you take a look at the measurement from the peak, the trough to the peak, and if I can measure that line, so I mean, more or less, you can say from 197 up to 210. All right. So approximately, just you know, work with me with math, about 14 points. So if you add 14 points to 203, you're going to come up to about 222. So the measurement, if this truly is a measurement technique, stair step, up, down, takes off, and then continues to the upside, we haven't really seen that blow off pattern. The funny thing is, if energy stocks are declining, if the financials are declining, then what in the world is running the advanced decline, showing that more stocks, we just broke out in the S&Ps. We just broke out in the S&Ps. We perked our little head up by just a little bit. The only thing missing is the volume. So from the perspective of the Russell, the volume looks best in the Russell. There's just a lack of volume in in the S&Ps. And that might come as now more people feel a little bit more confident about the market and the Fed and the fact that they're not maybe exposed to the market. And when you get to a quarter and people send out those statements, we might see some quarterly position adjustments which might be different this year and mute, keyword, mute the Ides of March or seasonal decline in the market. That's kind of what I'm probably suggesting. Now, if you look at what I wrote, one of the things that is just amazing to me is I've been doing this for about, what, a year and a half at least, and sharing, and I know that when I put together the scans, which I thought were important for measuring the strength, weakness of an overall index, and I wrote about it in Mastering the Stock Market. So the book was, what, correct me if I'm wrong, released in 12, written throughout 11 or so. But one of the scans that we created, and there was a good reason for it, was to find out how strong or weak is the stock market. Well, if the majority of stocks are above a specific long-term moving average, and a lot of people look at the 50 and the 20 and the 200 day, I like to be a little bit more time sensitive, which seems to be working. If you've noticed that I've put this on the finer points from a technical perspective in our sheets. One of the things that I've pointed out to people is that on a given week, and I'll open this up for you and show you exactly what I'm reading off of. Right here, the S&Ps. How long have I been putting that up for well, maybe, I guess, my own benefit, a long time. And we have those scans and I created the scans in Genesis. In fact, if we take a look together, you'll see if I'm right, or if this computer's right, at least, and utilizing, see, and I think that's the key, is traders don't ask enough questions, and I think they need to ask better questions. And the question is, if the market's weak, then we're not going to have a lot of stocks above a 10-day moving average. We had 435 stocks in the S&P 500 above their 10-day moving average. Well, if you recall, last week on the dip, right, we were at like 130, and that tends to be an oversold. Now, right now, 434 stocks tends to be overbought. So I would expect maybe an early week possible pause, because and what's amazing is when you look at all of these stocks above 435 names above their 10-day respected moving averages, then what the heck have the energy stocks been doing? Because with crude oil and moving down and the financials not participating, you're telling me that these stocks are not below their 50-day moving average. They're above their 10-day moving average. So, I mean, literally, that's got to tell you something about the health of the market. So when I look at this and I look at the advanced decline making new highs, it does jive, and it is good confirmation that there's a lot of stock out there being bought up and still holding above their respected short-term moving averages. The daily McClellan oscillator, another one of my top tools that we've been looking at. And I know if you go back and you can re-examine some of these videos, I'm pretty sure on the monthly or at the beginning of the month and even last week or the week before, I know that we go through and take a look at not just the health and the breadth of the market, but we take a look at the McClellan oscillator. Now, this is a daily chart, and we went from an extreme reading, which we had down here, and we were gone from bearish to neutral to bullish. And now I think there still might be some upside left, and then we might get a little bit of it from wherever the market goes up to. So listen to my theory. My theory is we're probably got a little bit more short-term upside, and then going into a few days of pullback, and that'll give the seasonal people, hey, see, we warned you, the Ides of March worked. But in reality, the market moved up higher first and then down. So I think it's going to be a little bit tricky, and I want to just still stay on the long side, exposed to the long side of the market with these positions. When I changed to the weekly, one of the cautionary, this is from, I think, last week even, when we get down in the weekly basis, we start to see the fact that market has gotten oversold, and we can see rallies. I mean, guys, this is from 2 weeks ago. So the moral of the story is the indicators and the analysis that we're using has been helpful in saying, let's not throw out the baby in the bathwater and get ultimately short and start looking for, and the key is decent stocks with low risk, or look for low risk trades. Now, sometimes low risk trades comes with low return, but in an environment that we've been in, I think it's been the right approach because we have the opportunity to see strong, significant pops. We can always do better, and I know that, man. I can always do better. There's no doubt. But in an environment that has been as, flat in the sense of its aggressive moves to corrective modes, then explosive upsides, this market here is not still in any way, shape, fashion from a longer term perspective nearing an overbought territory. So how many weeks when we start to see upticks do we go from oversold to overbought? Oh, that would be a pretty decent question, John. I would want an answer to that. Would you guys want an answer to that? From a time period of this cycling effect from oversold to overbought, from oversold to overbought. What's the amount of time that we might see something like that occur? And it's about maybe anywhere from 6 to 8 weeks. 6 to 8 weeks. What would 6 to 8 weeks bring us from right now? About mid-May. So I think there's upside in the market going into the sell and may go away time period. And I know I said last week with the Fed putting things on pause and saying they want to look at the employment, a few more employment numbers, because I'm pretty sure I saw that across the screen there with Janet Yellen's press conference. That gives us at least going into April and at least going into May's unemployment number. And therefore, I think they're, with the energy complex and the financial complex maybe recovering, and the fact that so many institutional investors might be short bought this market, and that's been a regular theme over the last 2 years, we could see some more upside over the next 8 weeks. So 6 to 8 weeks to the upside is typically what sometimes it takes from the McClellan oscillator to get from an extremely oversold to potentially extremely overbought. And and as you can see, we're starting to grind up. If we can get that zero line cross, and then it could accelerate faster, right? We'll get a, as soon as you get that zero line cross and then accelerates to the upside, then you go through a period of a correction mode. And it'll be up to seeing how long does a correction mode last. Remember what a correction is. A correction either can go down, or a correction can go sideways, okay? And that's what I would probably, we're going to have to do more work. I don't think we get a sideways correction from an aggressive upside move. I don't think if we get an aggressive upside move in the 6 to 8 week period, I do not think it's going to be sideways. I think it'll be kind of like a pump and dump because of the lack of volume. My opinion will change if in the next 6 to 8 weeks the market goes up and we see an accumulation of uptick in volume, which would reduce the chance of a volume bearish divergence situation. Okay? So from a macro sense, I'm giving this information to you guys for the fact that I won't be here. I'll be in Paris just in case something does come up. I want to make sure that you guys have that understanding, and for you, everyone that has Genesis, I've created these indicators so that you can follow that on your own. All right, next, let's move into looking at sectors and subsectors. All right, since 2000, or at the beginning of 14, which I'm trying to get this thing, get it exact, more or less close enough for government work. I always say that. This is the one sector that has been the thorn in my side. I have not been able, I've been looking at the divergence in volumes on this. I've been scared about this. I'm pretty sure we're in a hyperbolic or parabolic market phase in the market here, and it's the IBB. I'm not backing off of that statement. I do feel from a seasonal perspective, things that could happen in Washington, D.C. that could change or alter fiscal policy changes in the healthcare sector or business, that this is a little bit ahead of itself. So I'm still looking at this sector to see seasonal weakness, which happens in March. It's just happening later than we were anticipating. The other side of the coin is looking at the XLU and the utility sector. The XLU tends to see rebounds, and it's right in here over that time period. It's in the mid-tier sector of this graph. Underperformance would be XOP. Underperformance in this market would be XLE. As you can clearly see, XOP down 26% since this longer term view. But note what it is doing though. It is forming as crude oil has been making newer lows. And I wanted you guys to take a look at this. While crude oil has been, trying to push down to new lows, the XOP is making relative newer, higher lows. So it is showing kind of a basing, and it's not just the XOP. Do note that so is the XLE. It's doing the same thing. Will it get back to unchanged and up on the year? That's to be seen. But right now, from a relative strength performance, you can see that while crude oil is going down, this sector is basing itself out. An accelerated upside in IBB and a departure from a longer term trend tells me we could go from maybe 40% up, and that's just in this time period. If we get back to trend, it would be at least a 10% correction. And if we get back to where we were at just the downside in December, just to get back to where we were, And I don't know if we'll get back to where we were in December, but clearly we could get back into this old support resistance level in here, which would be about a 20% pullback in the market in IBB. And I think that is what the threat is for following. While out in San Francisco and asking people what they're now trading, I mean, 5 years ago, if I asked people if they were in biotech, they wouldn't know what the heck I was talking about. But the majority of people raised their hand and said, oh yeah, I'm in it. And that, to me, as I've been saying, the biotech world has gone from the institution's hands early to now the retail hands late. And it is a late stage market move, and the general public is in it. Now, it's a matter of the hot potato game. He who sits down first gets a chair, right? He who doesn't gets left out of the cold. And the moral of that story is simply, he who gets out of the biotech first is going to be the winner. He who hangs around the last and the longest is going to be the loser. And so I just want everyone to be kind of aware of what might be the catalyst for keeping one segment or sector or index down, which is the NASDAQ, relative to the others. In addition, I wanted to just quickly say, well, where's the rest of the world? And what's been going on? And in this time period where it seemed that a lot of stocks were generating in different, not stocks, but stock indices around the world, Germany, Italy, emerging markets, Malaysia, France, Italy, we were all kind of moving in tandem with, of course, some outperforming others, right, which was Italy. But Italy, as my friends say, Italy had, seen a little bit underperformance in prior years. But as I stretch this out and go from December of 2013, we can all see the narrowing or the convergence and the markets trading together. What does this line represent? That line represents July last year when Janet Yellen spoke. And all of a sudden, crude oil started to go down, and all of a sudden Ukraine and Russia situation unfolded. So from that time point, look what we did. We started to depart, and everything started to unwind a little bit. We saw a huge disparity or disconnect between global markets and the U.S. So there is something to be said about what Janet Yellen, and it was that point in time, and that we've kept that line on this chart since that time period. Now, I think what's happening, and we'll start to see happen, is that with Janet Yellen coming to the rescue, I think in last week's commentaries, we should see at the very least the market try to, if this is just a double bottom, an upside move, and we should start to see some of this differential start to unwind as the central banks are starting to initiate their own quantitative easing. I'm not sure about Malaysia. It's a whole different ball game. And of course, Latin America is what I'm going to suggest and have been suggesting is going to be the surprise market recovery segment of the market, because it's the one that has gotten the most beaten up. It has the one that has the most to gain. And when I look at emerging markets, the EEM, right, the EEM has just been absolutely flatlined, and I can't imagine the EEM outpacing growth right now, right this very second. But it is on the uptake, and it is struggling against getting positive, as you can clearly see. It's just barely positive. It's up 0.3% right now in this whole time period. So money managers who've been telling people, oh, you got to be exposed to the emerging markets. Well, since approximately December 9th of 2013, the S&Ps have up 20%, and your emerging markets are losing money. And remember, the EEM, what's going on? This is priced in dollars. So really, you did have a currency loss, but it's priced in dollars. So therefore, you don't have more exasperating losses to this. It's just that's the net effect. You're only up 0.3% on your money in that whole time period. So I guess money managers do cling to the fact that, hey, eventually we're going to be right and it's going to be great. And I think what's really neat is that we can utilize tools to say, you know what, when I start to see the market break out, and I see the momentum come back into the game, and I start to see the EEM start to really accelerate and start to drive a trend, then I'm going to get in it. But until that happens, I think we're going to stick with the leader, and that's what relative strength analysis helps us with. Identify the leader, and the leader still is the S&Ps, and I think we still got a little bit more upside. And I think maybe in this time period, the market, it would not be unlikely to see the market by maybe the May time period in this S&P get from up 20% to up 25%. That would be an additional 5% move in the S&Ps. Wow. What would happen if the S&Ps went up another 5%? Let's take a look. Where would they have to go? Where would the market be? So part of my analysis is not to talk in terms of where a market could go in price, but also in terms of percentage. So what would be the price level if the S&Ps went up another 5%? So let's take a gander. Huh, interesting. Holy moly. Well, that's 5.8%, and I just looked at an ABCD wave with you guys, did I not? I just looked at an ABCD wave suggesting we could see the market move up based on the relative strength. So I'm looking at this market several different ways. I'm looking at the breadth analysis, I'm looking at the percent change analysis, I'm looking at relative strength analysis, and I'm comparing it over a period of time, and it's coming to the conclusion that we all, a lot of work has gone into figuring this out, but if we went up another 5% of the market, right, we would be near 220. So this is a level that we had a minimum objective put on our charts from a while ago, last week or so, at least 2 weeks ago. And I think if this market ABCD wave does want to get up there, we could easily see 5% move in the spiders. So when someone says, well, John, why did you get out of the Russell? Because I see a potential 3 to 5% move coming in the spiders. Last time I made a call like this was a year ago. Many of you were my clients a year ago, or just about thinking about being a client. And I said, hey guys, while the world is selling the stock market in April, remember when I said the NASDAQ looks very strong to me, we could have at least a 3% upside move in the Qs, and we positioned ourselves for it. And I was dead ass wrong. There's no way else to say it. I was dead ass wrong. The NASDAQ did not go up 3%. It went up 9%. I was way out of line. Now, I'm not saying that this market can go up 9%, but I don't think it's unrealistic in this condition and this type of market environment to see maybe the spiders, the SPOOs, call them what you will, SPOOs, because the first listing in the S&P 500 was September, and the September symbiology for S&Ps on the floor of the exchange was U. So on the board, just a little history lesson, we had SPU. SPU, and if you spell it out, it's SPOOs. So all the old timers call the S&Ps SPOOs just because that was how it was first taught. Now the new traders are all talking about trading, oh, I trade the YM or I trade the ES, and I still call them the SPOOs. So I guess that's a nomenclature to find out who's the rookie and who's been trading too long and been around the world too much, and that would be me. So maybe I need to start looking at slowing down and stop moving. Anyway, and as soon as you do that, they put you in the ground by 6 feet. So let me reevaluate that sentence. I look at the Qs, and this is a daily chart, and I see the advanced decline perked its head up, and I don't see the price perk its head up yet. But I also see something else that intrigues me very much so. Since the move over here, while we are moving up, we've seen a little correction, and we are in the on-balance volume indicator. We've taken out this old high here, which, remember, this is like February. We saw a little break. We saw the pullback, which we positioned for, and then we said, let's watch out. And now, looking at the cash market, the Qs, guys, we broke out to the upside. So what's going to run the roost of the Qs. That is not just, you know, a few names, high beta weighted stocks running the roost. The majority of the stocks had broken out to the upside. Broke out in the S&Ps, broke out in the Qs, and we didn't get that breakout in the Dow, and we've been saying that for a while, but it did not break out to a new high because the Dow didn't break out to a new high quite yet, right? Now when we look at the NYSE, just as a gander here, just to give you a look-see, this beast here, which we teach at a lot of the seminars and we'll tell you, only 68% of the stocks are U.S.-based company in the NYSE. So this might be giving a lot of people who utilize breadth analysis, they're not just using breadth analysis in the right, you know, and using it in the content that it could be better used. And the better use is to take a look at all the stock indices. So when I look at the U.S.-based markets, the spiders, the Qs, the Russell, you know, when we go from blue chip to technology, biotech, to a few strong retailers like Costco and Starbucks, and I go over here to the Russell growth sector, and I see that kind of strength in numbers. Remember, strength in numbers. The amount of stocks going up, it's going to take an enormous amount of power to unwind that. It's not a few stocks going up. It's the majority of stocks going up. And strength in numbers is the theory behind this type of analysis to suggest more upside in the market. Okay? So, this is normally a shortened version, but just to go through for Monday's planning and scanning, I just wanted to go through some of the things that we've been looking at and why I look at and explain what this McClellan oscillator is. The spiders, the Qs, the Russell, everything's in a buy mode. Okay? So with that said, we've got some consumer discretionary that we had from last week that we're still stocking, which Ford I like, and Green Mountain Coffee Roasters. And you guys can take a look at those stocks to watch. Biotech is still on my bearish setup. It's on the cusp of a bubble. I'm buying lightly some May weekly 320 strike puts. I'm going to risk half the premium. I'm going to throw good money after bad. Yes, I am. And that's the way it works. So with that said, I want to say good luck this week, everybody. I hope you found value in this session from Monday's planning and scanning. And then we'll move forward. So with that said, everyone, have a great trading week. Thank you. That does conclude Monday's planning and scanning.